What's up, outliers? Happy Saturday. The goal for the stream today is slightly different. We're actually finally making a couple changes to the Saturday stream to try and accommodate a broader group of people. So on Saturday, I intend to look at GameStop still every single Saturday because that's part of our ongoing tradition now for 40 episodes. So that's not going anywhere. But I get a lot of emails from people asking if I'm willing to take a look at other stocks, and specifically in like the meme stock world. So my thought is we can still spend time obviously going through GameStop, but then we can take a look at a couple other popular names depending on what's going on at the time. Again, mostly to explore the broader sphere. So Lauren says like SOFI. We definitely could look at SOFI. I'm down for that. That's kind of the point is I really do get quite a people reaching out saying if I can look at stuff like AMC, if I can look at Best Buy, if I can look at Palantir. But I honestly think calling Palantir a meme stock is a tough go at this point, but we'll still look at it. And again, I want to be really clear when we're talking about stuff like meme stocks inside our community, it really is not a denigrative term at all. It literally just means that it's a stock that typically exhibits higher volatility and is popular on social media. Like that's really what it boils down to. That's not good or bad. That just is a function of it, which again, I'm completely indifferent to. So that is what we'll do today. Now, first off, I am happy we could poke through a couple individual names that you guys want, and then we'll spend the back half going through GameStop because I want to talk about the broader options flow that we saw last week, as you saw in the waiting room before we started. And then I do want to poke through the DD library a little bit more, but we'll save especially the DD library for the end simply because you kind of have to get in the right mindset to work through that. So it's a little more difficult for my brain to get in the right mindset for the DD library and then switch between other stuff. So we can take a look at SOFI. As soon as I click the box, I got a thing up here that says delayed data. So let's see what happens. Looks like I'm still on the stream. Let me know if I drop off in the comments. It might be Thinkorswim could be going under maintenance. Literally looks like that's exactly what happened. That's right. We could just use some of the other platforms. Not a big deal. Kind of hilarious on the timing though. Like literally just as we start. Love that for me. That's okay. All right. Let's start. We'll take a look at SOFI. Now, from SOFI's lens, let's take a look at net premium. And we need to zoom this out. Oh, wow. So on the 9th in the morning, very, very clear spike, man. That's like a really profound spike. And it ran all the way up until on the 8th, it ran all the way up. And then on the 9th, it dipped down pretty hard. So on the 8th is when we saw a really serious acceleration here. So let's see what's going on. A lot of near-term activity. That is very easy to see. What I would like to look at is the distribution of OI, which I can't right now because this is not working, but we can take a look at actual current OI. So across strikes, it looks like broadly calls running on the 13.5s, 13s. It looks like kind of call skew along most of the out of the monies. And then for the out of the money on the downside is when the puts start to pop up. So there is some standard hedging behavior going on in here, which is always interesting to me, especially in names like this, where it seems like there can be just such dominant upside expectation. So to see this kind of distribution is not like super remarkable, but it is semi-remarkable to me. Now, looking at expiration based, the front expirations are very, very call heavy. And then it kind of remains call heavy. Not until you get way out here, until June, that you start to see the put side picking up, but it still doesn't exceed the calls. Not until you get way further out, until like October. So yeah, I mean, the OI skew seems really, really centered on the call side. One quick admin note, if anybody else in the chat has Thinkorswim, if you can periodically try logging on and then let me know if it eventually lets you on, so then I can restart mine. But let's take a look at this next. So what I'm doing here is I'm getting a sense of total volume. We can get a sense of total volume across strikes and across expirations. So right now we're looking at the call side of the equation. And all I'm doing is getting a sense of where it seems to be the most dominant. And you can see it's done by a heat map, so it's pretty clear. The front expirations are just absolutely the mass of what you see. And it's literally like from Friday into next week. A lot of this volume on Friday is likely front expirations that are being moved out because it didn't hit, you know, the profit targets that were going, right? So you can see that pretty heavily here at the 13s and the 13 and a halves and the 14s. So the at the monies. So this just, to me, I imagine a lot of this, like 11K is coming from this 21K, meaning people are closing out of these, moving out to these. Same thing with this. So what that generally tells me is people are just looking to maintain exposure. Like that's in a nutshell what that means to me. Now, let's take a look at overall premium. At the monies. Yeah, I mean, nothing. What I'm looking for here, by the way, is like any distance spikes. I'm looking for anywhere that I can find like really, really strong premiums, which I don't really see. It looks, yeah, I mean, it looks pretty at the money centric. Okay, so now let's take a look, see if anything interesting is going on. Badger Lord says trying to log in, stuck on updates. Awesome. Thank you guys. I appreciate you guys taking a look at it though. Because so I like Unusual Whales, as you all know. And again, they're not like sponsoring this. I am affiliated with them, but it's because I like legitimately like the tool. But there are absolutely things that this cannot do that Toss can for me, which is why hopefully we can get that to turn on. But that aside, let's take a look through just recent transactions. This is always good to get a sense of institutional sponsorship. And it's like super slow. Like that's what I see here. It looks like this homie, Kelly, I have no fucking idea how you say this. Any guesses? Any phonetic spellers know how to say this? I know that's going to be like lock. I'm not going to sound that whole thing out, but they've been selling for a little while, but I mean, it's not like big and they're not really that large of a holder. Let's take a look at the institutional side, what the sponsorship looks like. Oh, interesting. So it looks like the total net change in ownership hasn't been, it's not as sponsored as I would have thought from an institutional lens. What's the total? I assume this is the number of names. What I would like to see is the total percentage. That's always a good metric, and I don't see that in here. Mostly seems build out. I was trying to get a sense of scale. What is their current total institutional ownership? Do you guys know? I can look it up if not. Take a look at SOFI. Let's go to not maybe inside. No. I'm just gonna look it up. SOFI institutional. This is normally a good source for this is through Fintel. Except it's not loading for some reason. Why though? Dude, is it just my internet that's being absolutely awful today? No, this one works just fine. Looks like everything is doing maintenance right now. That's kind of funny. Literally everything is doing maintenance right now. All right, let's see. Institutional ownership, 46.5%. Good old NASDAQ. Good old NASDAQ getting it done. So 817 are holding 513 mil. Let's see. I want to see how accurate that is. This shows 772, so it lags because this is just from Q4. It would be nice if they built this out a little bit more. What would be really cool on this tool would be like a total institutional sponsorship in terms of not just volume, but net holdings. It's a really useful metric because it gives you a lot of insight as to whether or not institutions are looking to continue to expand into something and consume more of it. But then it also gives you a lot of insight into how much something can move. Because what happens is, as institutional ownership goes up and up and up, it decreases the amount that something can move around because a lot of the shares become locked. So if we take a look at some of bigger tech names like Microsoft, you can see it's 72.2% institutionally held. So what that means is if Microsoft wants to have some sort of big kind of move, it's more difficult when more of it is being held on to by different kinds of institutions, ETFs. This is where you get into the really interesting world of structural trading opportunities within the market. And it's because you can come up with inferences off of stuff like this. So now if we go back to SOFI, like we were just looking at, Notice the institutional holdings in SOFI comparatively, right? Significantly less. So when you see things with lower institutional ownership, it means that the volatility tends to be higher. And it's because it changes hands more readily. As institutions start to scoop up shares, they're slower to move things, especially, again, when it starts getting picked up by ETFs and stuff like that. Like SPY is not moving much of its Apple holdings. It'll rebalance it, and that will cause some of the movement, but that's about it. It's going to maintain the overall target exposure. So just something to be aware of when you look at this stuff, and that's why I think that would be a great tool to have here, is like a not just volume, but literally a net institutional ownership view, because this looks like total holdings here. This is only showing 772. This looks like the number of companies, which isn't like the number of okay, cool. Like there's nothing wrong with knowing that, but that's also not like something that I think I can't do that much with that information. It doesn't matter to me that much at all. So now let's take a look. I want to do one other peek on this SOFI. So another tool that is useful for this is Benzinga. I have no idea. Oh, these are like different earnings stuff. Overall profitability metrics. I don't really care about that. Squish all that down. Let's take a look at insiders here. Wow, heavy in the options markets from an insider lens. Ain't that something? What's the short interest? 13.5. Light. That's really, really light. Short float. You're not really going to get a ton of movement on that kind of thing. Yeah, it's just not enough from a short holdings perspective. Cool. Let's see if there's any interesting options positioning. I want to look through a couple other things. This, one of the reasons, by the way, why I'm going through all this with SOFI is because I don't necessarily track SOFI as close as other names. So what I'm doing is I'm building just an overall understanding of like the recent movements in it. Something like beta is actually quite important to me, and it's because beta tells me how volatile is remaining comparatively to a benchmark. And again, you can see that this is natively using SPY, which I think is a really great benchmark. But that's why I'm looking at that. And then this is just telling me what the overall options activity looks like from a flow perspective, calls to puts. And this is looking at it in terms of volume. Again, I actually don't care to look at it by volume outright. I prefer something like this to be by premium. And the reason is because you can uncover some really big, low volume trades that are very high premium. So, and we did this recently in GameStop with those short puts that were in the money. That's like a prime time example of that. So, yeah. I don't care about this. That's looking at an individual option. I don't care about this stuff. Okay. Let's take a look at an actual chart. I don't need the. So on a 3-month time frame, on a 3-month time frame, this is not really looking that great. I'm just going to add a couple basic studies really quick. Moving average. No, I don't like this one. Channel fill, don't want that. I don't want this. Now we get to play with new fucking tickers. This is perfect. 50-day MA. Beautiful. Make sure that the longer term ones are exponential for sure. And then we'll add another one that's shorter term. We'll do a 20 period. Perfect. And then we do one more. That's a really short term, like a 10 or a 9. And see the relationship here. So the reason why I like moving averages for this is you don't need to put a ton of shit on this in order to get usable information. Another one that would be really good though is a volume profile. If this thing has that. It does. Volume profile is a super, super, super useful tool. And it gives us a ton of information. Yeah, so I'm actually really, really happy that they have this. I like to make it a little less. That's good. Solid. Beautiful. So the volume profile, I care about this because it gives me really important context on what the overall behavior has been in the name. So when we're looking at something like SOFI, here's a few key things I can tell you. That there's some really important volume nodes here at like the 1564 handle, like up in this range. And where we're transacting now is like a moderate shelf around this volume node, but not the biggest volume node. So now what this objectively tells us is it lets us know that as SOFI might rally, it is very likely to start running into overhead resistance once it gets up to this like 483 handle. That's what you're seeing. Like pretty high probability. Now that doesn't mean it can't break through it, as hopefully you know. The support and resistance, it's support and resistance until it's not, right? So you don't like read way too far into that. But if we zoom this in now and we kind of get to a more relevant time frame, so this is looking at the last, what, 4 months? Let's do the last 5 months. We'll do like this. And it has, I just want a line, bro. What the fuck? If you guys needed an arrow, I now know how to draw an obnoxiously large arrow. Can I delete that? That's great. What does this thing do? Nope, don't want that. Yo, I literally just want like a trend line. Channel, no. Continuous, no. There we go. A line. What does this line tell me? Ah, that's great. Perfect. We found it. We found what we needed. Look at us go. So this is dropped 27%. So it's dropped 27% over 74 trading days. This is actually really, really useful. This is good. Okay, now close. Yo. I don't need this thing anymore. Go away. That's fine. You could live there. So overhead resistance 425 for sure. This is like absolutely the bulk of the volume node that we're going to see. I think, I mean, from a near-term price perspective, you are seeing at least a near-term rally. And you can see that noted by the higher local highs and the higher local lows, both of those combined. But what's not a great vibe is the fact that it tried to pop up here and then it got pushed back down, right? It's starting to run into this volume node. And one of the things you'll notice is as we zoom in, you'll get a better sense of different volume nodes. And the reason is because it tells you where people transacted at different points, which is why when you're using something like a volume profile, you have to zoom out far enough to see where the bag hodlers are, because that's what this is, right? If I zoom out far enough, I can see exactly where a bunch of people started phasing into the position and they're in a bad spot. So for example, this is going back again to January 24th. So if I zoom this out, notice how that bar is going further and further up. What that tells you is that there's a ton of people from January 24th and before that are buying at these really high levels. And then you don't see those people go away until we get like pretty far out in time, until we're back in November before the key breakout that it had. So what this tells us is that there is a not small group of people, actually the bulk of trading volume had entered in near the tops here. So then often this is when that group starts to say to themselves, do I want to be in this name? And that's a tough question because they then need to essentially figure out what they're going to do as it rallies up. But this is where a lot of people will start to unwind. Now, going back to the point that we learned earlier about the importance of understanding institutional ownership. If this was 80% institutionally owned stock, what do I think might happen as it gets up to this 510 handle? Realistically, not a whole lot. And it's because institutions typically are less interested in actively cycling buy and sell. But because we know this is like less than 50% institutionally owned, that means that there's not an insignificant number of individual people holding this, small shops, stuff like that, that are going to be quite eager to get out as it hits this. So in those cases, really all it tells me is that there's likely to be a fair number of people that are eager to get out of the name when it gets there. That's exactly what I would expect to see. Cool. So now from an options, why can't I delete this? Dude, this is so funny. Every time, I mean, it's fun learning different tools. That's cool and all. Maybe if I double click it, nope. Yo, if you guys have any tips or tricks, there it goes. We got it. Okay, so now let's take a look at the actual options chain really fast since Thinkorswim is not playing nice. And we'll look at 50 strikes. I normally don't use this, so there we go. Okay. Okay. This ain't bad. Do I have Greeks? We do have Greeks. We even have Charm and Vanna. That's actually sick. Good. Where's Theta? Why the fuck would Theta not be on this list? How does that make any sense to anybody? There it is. Where the fuck is it? Oh, I might just have to scroll. I just got to get rid of some of this extra shit. We'll get rid of the high, low, don't care. Average last is fine. Plus minus is fine. There's Theta. Beautiful. Okay, cool. So let's see. what I'm doing now is I'm just getting a sense of what the options chain looks like. And I want to get a sense like relative to different deltas. So we obviously need to go out into next week. And let's take a look. So the at the money is like this 13 and a half. And what's the IV skew? So the IV skew on the 39 deltas is 56%, and on the 41s it's 56. So there's a little bit of call skew, not like super heavy. So after like a quick poke through of SOFI and tinkering with some different tools just to get a fucking feet under me with using this thing compared to Thinkorswim, my usual, it looks like there's bullish call flow and positioning expectations, but they're really like right now, price is not behaving super well relative to that, in my opinion. So with these kinds of things, I normally would look at it as if we see it starting to break above key resistance, then I'm immediately more interested. But with it behaving like this now, it effectively needs to get over like this handle for sure. So this is the 1375 handle. But the way that this can be played is, for me, the way I would play it is this becomes near-term resistance. The bottom of these candles, the congestion of these moving averages, those kinds of things. And the way that that gets played is stop goes below there. So stop goes somewhere around like 1240, something like that. And then I would probably wait to see if you see it breaking above like this 1376 handle though. But if I thought that it was going to move and I wouldn't want to wait that long to miss the entry, I would just enter a little bit smaller with the expectation of high probability of being stopped, and then scale into it if it starts to have that up move, which is from the options markets. It does look like it wants to go that route, but you need the price performance really to support it. So yeah, I mean, you can see where the pinning is, which it was just north of max pain. Cool. Fun look. It does look overall, I mean, it does look like it's overall being positively positioned, right? Take a look at the net call flow. The problem is, and this is a good example of how options flow is not omnipotent. And you have to think about the timing of things, because you can see the options flow really started spiking back here, which was what, 23 April. So if we take a look at the price chart from 23 April, right? That's here. What has happened since all of that started happening? The fucking thing has gone down. This is why I use options flow in conjunction with other indicators. Because another thing that when we're looking at the net premiums, this is def tone in the sense of this is just call premiums. We don't know where these are. And this is actually why it's really important to look at stuff like this. And what do you notice about the highest OI contracts? 250 days for the call side, 250 days for the call side, 250 days for the call side, 40 days, 250 days for the call side. There's two that exist in here, one at 40, one at 5, that are sub 100 days. So what this tells you is that a lot of that positioning that you see is actually longer term expectation, not necessarily some sort of near term expectation. So interesting look. I'm going to move this over here, and I'm just going to close out Thinkorswim so that it's not spazzing in the background. And then we'll move on to the next. We could take a quick look through Yo, it literally doesn't want to close. There it goes. All right, we're good now. In case you were wondering what the background looks like, this is it. This is my wide monitor. So this monitor, I think, is like, I don't remember, 40 something. So you guys, I like cut it down to a little less than half for these. Okay. What else you guys got? Elsie says, did you discuss Strive, the BTC treasury, around an asset management co, reverse margining in ASST that went up 10x? They sent the activist letter to GME unless mistaken. No, we have not looked at that. Let's take a peek because I'm actually interested. Strive. First thing I'm going to do is ask ChatGPT about that. I'm literally going to post your question in. And I'm going to ask it to research the context of this. Can you research? And here, I'll actually grab a chat and we can look at it together. Can you research the context of this? Here. So we'll see what this is. I'm going to pop the door for Thorfest. All right, let's see. 7 May, Strive Asset Management announced a definitive agreement to merge with Asset Entities Inc., digital marketing content delivery company. Reverse merger positions Strive as the first publicly traded asset management firm with a Bitcoin treasury focus. Okay. The combined entity will operate under the Strive brand and it'll stay on NASDAQ. So Bitcoin for stock exchange, they plan to offer unique opportunity for Bitcoin holders to exchange their Bitcoin for company equity in a tax-free manner. Whoa. Whoa. That's fucking huge. That is absolutely huge. Wow. If that's accepted, that's fucking crazy. Wow. Expand on this. It might sound stupid, right? If you're not used to looking at this stuff more closely, but for people that are higher net worth, this can lead to a massive flow of capital from Bitcoin into other things. Now, my guess is that a lot of people that have built a lot of money with Bitcoin probably are just going to continue holding Bitcoin. But that doesn't mean that they might not break out some of it. So that's a massive potential draw for people that have made a lot of money. I want to know more about Section 351 of the tax code, though. This is so interesting. Provides immediate access shelf registration statement. Company can raise up to $1 billion through equity debt offerings to accumulate Bitcoin. Okay. This can give or take. This isn't inherently good or bad. Innovative strategies leverage institutional investment expertise to implement proprietary strategies for Bitcoin accumulation, including acquiring cash at a high discount through mergers and utilizing fixed income and derivatives. This is interesting because I also imagine that MicroStrategy isn't necessarily going to be ultra stoked on this because this isn't exactly what MicroStrategy is doing. Their intelligent leverage, which is fucking Spanish for Ponzi scheme, but this isn't that far off in terms of their broader goal of accumulating Bitcoin. Like that part I totally get. All right, so let's see the activist letter to GameStop. CEO Strive Management sent an activist letter to GameStop CEO Cohen proposing that the company adopt Bitcoin as primary treasury reserve asset. The letter emphasized that with nearly $5 billion in reserves, GameStop is uniquely opportunity to transform its financial future by becoming premier Bitcoin treasury company in the gaming sector. Well, this is interesting. Like a Bitcoin treasury company in the gaming sector. So expand on what this potentially could look like. Allocating maximum cash reserves to Bitcoin. This is, I mean, this doesn't make sense, to be honest. This to me strikes me as like a Bitcoin maximalist that is just trying to get more sponsorship of Bitcoin. That's genuinely what I believe. I like Bitcoin. I think it's a really interesting tool. I think it has valid use cases and it's proven itself and it's starting to expand in adoption. All of that stuff, I think, is unequivocally the case. However, that being said, GameStop, as it sits today, still has brick and mortar stores. And while it still has that element of its business, taking all of its cash and pivoting into something like Bitcoin, which is highly volatile, that can be a mistake. And let's close that out. Let's close this out. Let's take a quick look here. I just want to look at a chart of Bitcoin. I don't know what they use for Bitcoin. Do they have Bitcoin futures? Do they do futures? No. We could look at IBIT maybe. What is the ticker on this? Bitcoin spot ticker in unusual whales. They have it. BTC. The fuck is this? That ain't it. It doesn't look like they have futures. We can use IBIT. Not the same, but it'll give us something to look at and for the broader conversation point. So what I want to talk about with respect to IBIT, it's not like this move that you get to focus on only. When we're talking about something like getting into Bitcoin, it's more talking about this. It's a 29% drop. So that has, again, if a lot of your capital is in Bitcoin, that's not an insignificant drop. Let's just eyeball it really fast. A lot of fucking zeros to type in. So it represents a 1.45 billion decrease in assets. Like that's huge. That's literally huge. And something to remember is that, again, this doesn't go back far enough because it's just IBIT instead of the futures. But this isn't the biggest move that we've seen, and it's likely not going to be the biggest move that we will see. So I'm going to see if Thinkorswim works on my phone really fast. It looks like no. My guess is they're just doing maintenance. I wanted to see based on spot futures, like a broader view of like a worse move that's still recent, because I think that would add a flavor to like what this could look like. But this is super recent, right? And this isn't even like a crazy move. So this is like, again, a good display of why going full port Bitcoin as the reserve holding for the cash it's really not a great idea. And when people say stuff like this, and when I say people, I mean like in the letter, that cash has negative real return, the problem is that negative real return provides a purpose. And the purpose for the negative real rate of return is stability, way more stable than something like Bitcoin. And again, this doesn't even enter the equation of them getting into something that pays them a decent yield, which they could. That still doesn't inherently outpace inflation entirely, but you could cut inflation down, impact on the value of your money by a point. So that stability matters a lot. All right, let's see. Hurdle rate for capital deployment, using Bitcoin as a benchmark for evaluating investment opportunities, ensuring that any capital deployment would aim to outperform Bitcoin's returns. I think you have to, again, think of it in the lens of risk-adjusted returns, not just returns. This, I can see the argument for sure. The concept of decreasing brick and mortar footing and instead pivoting more so into digital side of things, to me, that's just logical. That just makes sense. I think GameStop is going to have to do this, and you can see them doing this, right? They're unwinding a lot of their store locations, and again, rightfully so, you have to. So GameStop store closure chart. I don't know how accurate this is, but it looks like it's generally curated. What is this? This one is from Super Stonk. So I imagine this is probably pretty accurate. Like Super Stonk is generally on top of their shit with this kind of stuff. So they closed 693 between 2019 and 20. Between 20 and 21, down 243. Between 21 and 22, down 160. Like, that bears out with what I would expect. And if we just eyeball the list here, wow. Wait, what is this? These are closings? Holy shit. I thought, did they really close all of these? How many is this? Fun fact, when I was in Anchorage, Alaska, I actually took a photo for you guys because there was a GameStop there. $401. Wow. So, I mean, that puts it into scale, doesn't it? I mean, that essentially shows a significant acceleration. IB says it on the title. I guess it did, didn't it? I have trust issues when it comes to like data and stuff. I have to check things, but that shows a massive acceleration in closures, which again, I really think just makes sense. I think GameStop has to do that in order to survive. So I agree with this. I think trying to do some sort of pitch that, you know, Bitcoin should be the main holding or something, I think that's a bit of a mistake. Badger Lord says, and they just sold all the Canadian stores. Yeah, I saw there was like some actual, I think it was like a game operator or something that purchased them. That actually looked solid. So ASST, let's take a look at this over a month. Yeah, this makes a ton of sense. This is exactly what you would expect on that news. Now, here's the interesting thing. Let's see if ASST shows us any signs that they knew that this was going to happen before it happened. No options. So that answers that. Damn. That would have been kind of fun. Okay. So Section 351 allows non-recognition of gain or loss when a property is transferred to a corporate solely in exchange for stock, and the transfers are in control of the corporation immediately after the exchange. Oh, that's cool. That's really cool. And this was the other follow-up we had asked, being a Bitcoin treasury in the gaming sector. So it says GameStop could move material portion of cash into Bitcoin. Okay. But then what? Establishes the company as a forward-thinking, crypto-aligned brand. Well, I think they already have that with the recent offering. Crypto integration into gaming products. I mean, yeah, this doesn't necessarily do them a lot of favors, though. Because I think using, like, this is the other reality is, like, Bitcoin isn't, it's not here yet. It's not at the point where people are wanting to make a bunch of, like, basic, smaller level transactions with Bitcoin. And it's because it's expensive on a relative basis. It's way too slow still. And a big part of that is because obviously you need the confirmations, and it's not like using a credit card where the credit card company is effectively saying, we're going to pay you no matter what, and then we'll deal with this person on the back end if they need to. That doesn't exist for Bitcoin just yet. So I think for Bitcoin to be widely adopted as like a payment mechanism like that, you really need easier spending infrastructure for it, which just doesn't exist yet. Lightning Network for microtransactions, like this makes sense. I think this would make a lot of sense if it's actually scalable and accessible. It's just not right now. Let's see. De-emphasize retail stores. I think that makes sense. Spin off physical assets. So this is framing it like it could potentially be more so of like a Bitcoin holding, just like that's the play. Yeah, Bitcoin backed dividend. That would be a massive change, yeah. That would be a really, really big change. Big bet too. Bitcoin doesn't seem like it's going anywhere, but it's also not necessarily growing at like a fiery exponential rate right now. So it's still, and that's just because adoption for these kinds of things is naturally going to be slow. It's just how it is. So let's take a look at the recent behavior from GameStop. And give me 1 sec. I just got to grab another water. All right. So let's see what's popping in the Bitcoin world. What do you see on the 9th? Huge call premiums. On a relative basis, massive. Let's go back a month. So this was 531. This was 487 up to 55. So this is like 30-day, 1 month highs here. That's pretty interesting. So let's take a look at where that is. Let's see. So it looks like the 35.5s got the treatment. And take a look at this. A lot of that is for this coming week. So that's a lot of like very, very strong near term positioning. That's kind of crazy. Let's see. We want this by premium. $3.8 mil against 246K. That's nuts. That was just for last week. So let's see what's going on here. Total calls 5.8 for the 16th of May against 653. That's really strong. 1.1 at the 28th. That's really strong. Huh. Let's take a look at what happened. Wow. So the 20s got absolutely activated. Silent, nothing going on. And then on the 9th, they just start getting slammed. I didn't see this. So this is one that if I go through my alerts, I definitely would have gotten alerts for this for a few different reasons as I look at this. But I mean, that's huge. 2103, volume is 2000, premium is 1.8. And then the premium here is 1263. Wow. That's really impressive. That's like really aggressive. And it's hard to tell because it actually looks like some of it might have also been unwound. What was the price change between 7, 10, 30, and 40? 7, 10, 30, 40. So it looks like some of this probably would have been sold off. Literally could have been like a really, really short term. Yeah. Let's. It's exactly what it looks like. So I wouldn't call it a scalp necessarily, but there definitely is some offload for sure. Huh. That's fascinating. 7, 8. That was like the average. Let's see. What did we get into towards the beginning? 7, 8. Yeah. I mean, these are in profit. Got in 7, 8. These are out for 8 on 40 contracts. Not a ton of money, but it's still a decent pickup. What were the delta on these? The in the money delta is an interesting choice. High delta. So by going further in the money, you get a better delta move. They're more expensive, but there's also the hedging requirement. Now, these are still 40 days out in time. So there's not a massive hedging concern like upfront because you still have time. But that's one of the reasons why going in the money can be interesting, especially for shorter term ideas, is because you start to force that hedging behavior, even if it's not inherently at like the ideal time, but to get them to start putting on share hedges to account for potential assignment or exercise, I should say, because these people would be long these options. Super interesting. IB says, huge risk to be long calls on GME. Not really. I actually don't agree with that at all. I think like any other options chain, it really depends on the way you choose to structure your position. But I mean, I've already shared it before, like from a covered strangle perspective, GameStop is the second best performing covered strangle in the portfolio. It's the first best in terms of how much money it has. But that's just because of the volatility. So being long options in something like GameStop can tear your face off if you're oversizing, or if you're like putting on stupid positions, you're going to light your money on fire. But there's nothing really that forces you to do that. You can absolutely put on smart trades if you're so inclined, which can work really, really well in something like this because of the volatility. So yeah, I don't really see it as super risky at all. I would be curious as to why you view it that way. Now, if we take a look, let's tighten this up a little bit. So we've been oscillating sideways in here for some time now. There's a really, really strong volume node that's built. And we can also see that, again, we have this plotted in Thinkorswim, but it does look relevant here. Let me grab that horizontal line here. Here. Okay. Oops. So this has us at like the 2110 handle, just like the sub 20. So if we zoom this, can you grab the access? You can. Great. I'm just pulling the squeeze out of here so that we can see the near-term price behavior. So you can see that there is some price activity down here, sub 21. But you can see before you get to 21, I mean, we really are in just the meat of overall volume and overall transaction volume. So the way that it's behaving lately, at least for the way that I trade GameStop, has been more so from just premium perspective. Selling puts, it's always maintaining high vol, and I'm not seeing the prevalence of the call skew. if I saw a higher prevalence of call skew, I absolutely would buy shares and sell calls, or sell naked calls with the intent to buy shares, set essentially a order if it starts to move up too much. But I'll show you what I mean in terms of the skew. Let's go to the chain. So if we go out 16th, what's the next main expiration? We'll go out to next month, the 20 Junes. Here. And if we take a look at the same delta equivalent call and put, let's do that. We'll do the 29 delta. And the vol on this side is 91% for a 29 delta. And if we go to a 29 delta on the put side, that puts us somewhere right around here. The vol is 73. So that's actually the biggest skew that we've seen for a while. That's still, I mean, that's a bigger skew than I was expecting to see. That's like a 20-point skew. That's significant enough. Now, if it's actually trading, there is another story, because we do need to see like what the bid and the offer is. Where is that? Bid ask, is that volume? I don't like the way that, yeah, it's the big ass volume. Where's like the fucking market? Normally I want to see bid and ask. What I'm trying to do is see how liquid it is. Anyways, that's still, I mean, that's decent enough. Let's take a look at the 23 of May. Let's take a look at the deltas here. So 33 is 51%. And 33 somewhere in here. This is like double. So the call side is heating up. This must have been from the activity on Friday. So to me, this actually starts to paint a different picture. This is the exact scenario that I'm talking about. That with the vol skew that strong, if it does remain to be this strong, I absolutely would take some of the short puts down, buy shares, and then sell calls against it to take that call skew. And then what I do to protect to the downside on that kind of position is the game plan will be really simple. Why can't I look at a chart? There you go. The game plan is really simple. All I do is set alerts to essentially get stopped out below near-term resistance. And I would just do it near the break even for the short calls, maybe, you know, a little bit edge on it. But that's exactly what I would do. So this is, we'll see how it actually behaves on Monday, but that looks interesting. All right. Let's take a quick look at the DD library quick. We'll maybe just run through one of them before I bounce, but I want to make sure we keep our cadence. So this is sorted old to new. Yeah, this looks old to new. And we're through these. Let me double check. Yeah, we definitely have seen this. So let's take a look at the next one. Hank's Big Bang Quant Apes Glitch. Let's go. We gotta zoom in. Damn, is there not like a fucking medium, happy medium? Zoom in. In this DD, I discuss why the meme stock craze is not just a bunch of retail traders pumping up stocks, which I agree with that. Instead, it's the product of greatest shorting fail in the market of all time that was made possible by easy money policies, Ape's uncanny ability to buy and hold. Next, I'll discuss statistical significance and origin of the FTD cycle. Finally, I'll give you a random dump of DD at the end of my thoughts. Oh, I'm actually fucking stoked for this. This is great. This is great. Can you guys see this? I can try to zoom in maybe on like the window itself, and then we'll just scroll. This is like 125% zoomed in. It doesn't look like it changes the magazine at all. I can download it. Let me know if it's visible. If it's really hard for you guys to see, let me know, and then I can just download it. If this is visible enough, then we'll just proceed as is. And in the meantime, I'm gonna swap out the bubble water because we about to get into it. I'm legitimately excited for this one. This looks cool. All right, I will take the silence as you guys can see. This talks about volume. Yeah, okay. So visualization, what we already know, but haven't been able to prove. The stocks are related. Ah. Okay, are they actually doing a correlation analysis? Certain tests you can run to determine if inputs are correlated to the degree of correlation. This is exactly what I did in undergrad and grad, so that's absolutely correct. Below the apes use statistical test. Ah, that's a bummer. I'm actually very curious what test they used. To determine the correlation of GameStop to other meme stocks. And the VIX? This should not have a high... I was going to say, this should not have a high correlation to VIX. Let's see. Top is a comparison of these stocks, while the bottom compares them in the last year. Okay. Okay. As you can see, the difference between all-time and last year is striking. The above decimals are called correlation coefficients, go up to 1. There's a lot with this, though. So one of the problems with the way that they ran this study in this way is that they're missing some really, really important behaviors. And you need to create a benchmark. Without a benchmark, this really isn't that useful, because depending on the year, and what this is saying is this is the last year. This was written in June 7 of 2021. What happened in the last year during this time frame where this was analyzed? Anybody remember a little something or other that happened during that time frame? The reason why this is important is because the next question I'm going to ask you is, what kind of impact do events like the thing we're talking about, little something that happened in that time frame, what effects on correlation do those kinds of events have? Talking about COVID. COVID happened in 2020, and the market obviously had a massive downtick. What happens during really big downticks is everything becomes correlated. Everything. So my guess is if you put in, I mean, we literally can run the study right now so that we don't even have to guess. This is super easy to do. Literally, ChatGPT can do this now, actually, like to a pretty good degree. And we'll just literally take a look at a couple benchmarks compared to whatever they come up with. The numbers will be a little bit different, I presume, just because of the techniques used. But I think overall it'll still be worth the look. So this is Microsoft, and we'll do daily, and we're going to ask for Microsoft from 2020. And we're going to run it until 2021, June. Okay. So that's one. We'll add another name. We'll add like Tesla. Same time frame. We'll add GameStop so that I have that data. And then let's add like Chevron. And then let's add one more, maybe like Pfizer. Cool. So now I need to steal my ChatGPT window back. I'm going to add the files. Create a correlation heat map for the following names, following tickers. Include the variance, strength, distance of the name. Cool. So we'll let this run in the background. It's going to have to clean it a little bit because there's some metadata in there, but I think you'll get the gist when it pops out. So anyways, we'll continue. So as you can see, all of them except for NAKD and NOG have strong correlation to GameStop. What really struck me was the VIX, because the market usually goes down when the VIX goes up. The fact that GameStop and VIX have such a strong correlation in the past year is extremely important for our thesis that HFs are actively acting against it. That's a bummer. If that's a big part of the thesis, that's not really a good... That's unfortunate. Ah, bummer. Damn, Daniel. Anyways, let's continue. Carpolo takes OTC data from FINRA, plots it for each of the meme stocks, how they seem to follow a pattern of spiking, FTD cycle. Okay. This, I think, is one of the initial cycle analysis DDs, isn't it? That's what this looks like to me from 2021. Squeezes are extremely rare. They're actually not, to be honest. How rare are short squeezes in the stock market? Let's see how it answers that broadly. So the correlations for those other names, so Chevron during that time frame was a 0.4, which is huge for Chevron at that time. Pfizer was a 0.58. Tesla was a 0.7. So what I'm showing you is a bunch of these correlations during that time frame, especially through 2020, is that just about everything became massively correlated. Let's see. Less than 0.5% of all stocks exhibit the classic squeeze characteristics in any given month. I think that's correct, definitely, because there's a bunch of stocks. There's like 6,000. So I would imagine it's a very small minority for sure. And then it says only 10 to 20 stocks per year see major high-profile squeezes with 3 to 5 times moves in a short time window. Yeah, I think that sounds right. So for me, at least, I wouldn't consider that extremely rare. It's rare, but it happens monthly, effectively. It's just not like this super widespread effect. Yeah, okay, so this is trying to do the math themselves. Let's see what they find. 100% increases, 200. Yeah, so they're also classifying a squeeze as like, I mean, that's like pretty high in terms of the total move. But yeah, I mean, these are actually, this is even higher than I would have guessed. So they're seeing higher than what we just saw. So yeah, I mean, that's actually pretty, I wouldn't consider that actually like super rare. Seeing the data, stocks are correlated. Does correlated mean there's some sort of orchestration going on or something forcing them to move in concert? No, that's true. Again, the other thing is, especially during the time frame that it was identified, is a highly anomalous period. Typically moves same direction, reason unknown. There are different tests you can do to not just measure the correlation in terms of like directional relationship, but you can do like Pearson and Spearman, which allow you to analyze a little more deeply using Spearman. Gives you insight into the actual strength of the relationship, not just the directional tendencies. So let's see. Okay. Rest of the market piling on. Buy orders. So I think this is talking about just the squeeze. Yep. Okay, let's go to the FTD cycle. First, demonstrating statistical significance of the FTD cycle so that we know it's not just a fluke. Yeah, this I want to see. I will discuss origins. Yeah, let's take a look. FTD cycle is the idea that because SEC regulations require market makers to cover FTD's 35 calendar days, there's a predictable increase in price and volume every 21-ish trading days or 35 calendar days. So far, it has continued to repeat itself. The idea that shorts are in so deep that they're doing some bare minimum to cover to continue to dig themselves a deeper hole by kicking the can down the road. Currently increasing exponentially, which indicates that it's getting more and more expensive to stay in the game. Okay. Orange line represents FTD cycle increases by each month. I want to know how they got that into Thinkorswim, because that to me looks like they're just doing like a time-based thing. Yellow lines are FTD cycles. Well, I mean, and this is a good example, right? Depending on what we consider the start date, that's what I need to see. But one of the things I've spent a while looking at with Newton was the various timing theories. And we've looked at it before on his sheet. And there definitely are relationships, but I still wouldn't consider them predictive relationships, which you kind of see that here as well, right? Like this cycle, it went down. This cycle, it really didn't do a whole lot. Even with this green candle, it's about flat from where it was. The other thing is a flawed component of this 35 calendar day thing is that we're expecting to wait the full 35 calendar days, which doesn't inherently make sense. So for example, if I know that I'm going to have to, again, based on their theory, cover part of my position, I'm not inherently going to wait until day 35. That doesn't really benefit me. What I'm going to try to do is find the best pricing over that month and a half or the, month and a week to get where I'm trying to get best pricing for what I'm trying to cover. I wouldn't inherently just wait 35 days. I think that's a really big mistake when analyzing the FTD cycles, is the assumption that we wait the entire 35 days. Below the chart, quant gapes gathered from Ortex showing SI, short interest stock, say that's inaccurate because real SI is hidden. Okay. Let's see. Where did short interest begin to grow? This makes sense. A big reason why you might see this kind of movement is because leading into like that kind of explosive of a move, it's generally a little bit more common to see short interest spike. But I also imagine, and this I think you guys would know better than me, it looks like LC just nuked their messages. I was wondering what the fuck was going on in the chat. You guys would know better than me, but I was expecting people to think that the short interest was even higher in this period leading into 2020. Is that about right? Or because I know that we think that the short interest was underreported, which I think is broadly supported, by the way. But I don't know how high like we thought it was leading into 2020. My general guess is that we thought it was like pretty damn high. So this is showing like 2017, 2018 short interest seemingly a little bit lower at like 28. The reason why I'm saying this is this actually could be even worse, you know, than what's shown here. And I think that that's completely viable from the short interest side. It's the same thing. The fact that like we see 140% short interest, like that shouldn't exist. So it would not surprise me at all to see this number even higher coming into 2020. Oops. Short interest, most of the meme stocks markedly increased 19. GameStop had an exceptional increase because of their issuance of bonds. Okay. So one of the things that I would want to look at personally with this, and this is one of the things that I think that the community unfortunately does too frequently in this kind of analysis, is focusing too much on the basket of interest and not including enough controls. So what makes this data more powerful is if, for example, we created a list of the most commonly of the top 10 decile, for example, of short interest names, because I think that actually would be a pretty powerful plot. I wonder if ChatGPT can find that. Can you find a plot of the highest short interest tickers by year? That would be powerful, because then it starts to show things like prevalence. How consistent are certain names at the top of the pack or not in the pack? How frequently do they cycle into the pack and out of the pack? All that stuff matters actually quite a lot. Fintel short squeeze scanner. Let's see if this is on target or not. Oh, Fintel didn't work for us before. And it's not working now. Shocker. Damn. So it looks like we'll have to do that one on our own. I can grab what we need for that. It'll just be on the back burner, but that's something I will take a look at out of curiosity, because I think it's worth it. Okay. So let's continue. Oh, I love this. So this is showing, yeah, this is great. NASDAQ short interest, this is great. So as you can see, short interest increased markedly. 2015 and 19 got me thinking must be some kind of law correlation with Fed policy or some kind of macroeconomic happening that led to this. This is a great investigative step, by the way. I personally think this isn't the right way to frame it, because this is a leading framing. The correct way to frame this thought, which is the underlying concept that they came up with, is way more to the effect of what happened in the years that had a spike in short interest. Because we can absolutely see a spike in 15, but this is also, like, to me, what's even more important are the percent changes. If we take a look at 09 to 10, that's a massive percent change. It's not necessarily the highest in terms of short interest, but that is of interest to me. Same thing from this period between 2010 and 2011. That's another massive spike that you see. So the way to think about these investigative questions is not to come up with your hypothesis of, I think it was a law or Fed policy related, but do your best to approach it more open-ended. You can have those in the back of your brain as like, these might be things I should look at because they could be causes. But again, when you conduct analysis in this way, it just forces you to be too centered on like the thing that you think it is, and you might miss other really useful details. So just general feedback for the person conducting the research, because it's really cool to see people doing this kind of research, but just different ways to tighten it up. All right, let's see. Not mortgage interest rate, federal funds rate, yep. Insanely low since the 90s, yep. Balance sheet of the Fed, yep. Okay. All right, let's see what they say here. The above graph is especially striking. Shows the Fed's balance sheet is increasing proportionally with the S&P 500. Fed's quantitative easing policies have been extremely aggressive since 2008. QE is where the Fed purposely stimulates the economy by buying assets like bonds. Yep. Necessary after 2008. Yep. Yep. This is good. I like that. Mean relative change to open previous day in X plus minus 1 days after green day. Mean relative change to open previous day, X plus 1 days, green day, Microsoft. Tesla. Okay, this is better. So here's a problem with this right out of the gate. The sizing and this, like the start of the plot that they're showing is good. The problem with this is these are in no way like comparisons. So you have to include these. And I'm really, really glad that they included these names, especially things like Tesla, which are higher volatility, and Microsoft, which we know is lower volatility, really big company. So it is literally perfect that they included these names. But to make this plot more meaningful, you have to include similar sized names. And it's because, especially at this point where GameStop is a much smaller company, they are always going to have more volatility. It's a nature of being a smaller company. So comparing the movement patterns of GameStop against Tesla, in this case, again, is perfect to painting the broader picture, but we need to see more of these. That's the main thing I wish was here, because otherwise I really, really like this. Okay, above charts show GME FTD cycle increases after a certain number of days. So one of the things I still don't know, and maybe one of you guys know, is like, how do we pick the day in this person's methodology? I've seen other people, how they pick the day, but how do we pick the day? I put Tesla and Microsoft in there so you could see how abnormal GME is. That's correct. Even compared to volatile stock like Tesla, that's correct. GME has a way more recognizable pattern, gives us further statistical evidence of the FTD cycle. That is not conclusive. Also note that there were many other users, different posts and sub who found the FTD cycle statistically significant. This is another view to add to that body of work. Below shows the short interest of meme stocks in relation to one another so you can see when they started and how they've increased together. So what is the start date though? X plus minus 1 days after Green Day? Is Green Day just an up day, or is Green Day something else? After Green Day. What does this mean? Let me see if the homie ChatGPT knows. What does this plot mean? Because I've been training ChatGPT on analyzing the frequency of the different cycle theories to try to track them down, because there's so many cycle theories now. But my goal is to find actually statistically significant All right, after a green day, specifically looking at the average to open price over the next 40 days. So it's just using a green day. So this doesn't tell us much, because like another thing we would want to include here is like positive drift. And we would want to see multiple time series. That would be really useful. So what I mean by that is I would plot a rotating number of the time series that starts on different days to show the termination over these durations. Okay, we'll continue though. I love this. I literally love the work. Let's see what's next. When did the short interest retail stocks start to increase significantly? Okay. What do we see here? Extremely easy lending environment. Rates are dirt cheap. Fed is buying up assets, which is pushing up the prices of literally all assets. Market flush with liquid assets, so much that the Fed was trying to slow it down. Perfect storm for short friendly environment. I agree with that. Now, one thing to note for the short friendly environment specifically is the rates aren't simply set by what the federal funds rate is. The other thing is there's premiums associated with the nature of the stock. So if things are hard to borrow, they're inherently more expensive to short, even if it's a low federal funds rate environment. Now, if it's a higher rate environment, that's just going to exacerbate it. So the one thing to note here is that this absolutely is completely correct, that it's a short friendly environment, but it is important to temper that with the fact that if something is hard to borrow, it still is relatively expensive, even if it's a low fund rate environment. What I think happened, longest bull market, high frequencies realized that this bull market was propped up on the Fed's massive balance sheet. Or hedge funds, sorry. I assume that's what that means instead of high frequency firms. Would need to be economic tightening, anticipating an end to the bull market, initiated a giant short campaign in 19. I mean, that's a hell of a. My guess is the timing might be something like that, but I absolutely would not say that that's the reason. The essentially building a giant short position just because of a long bull market, I cannot imagine that being the case. Now, again, the reason why they did it doesn't really matter. I agree with the finding that it absolutely does look like that short interest blew up during then, which is a completely fair observation. So the reason why I'm even mentioning that is because it's really important not to underestimate or misconstrue the motivations for quote unquote the enemy. And that's part of what this is. To essentially say it's just that is a little bit light. Convinced not continue to happen if the apes didn't hold. This is why it's all able to happen. Never been phenomenon on the market where a significant portion of investors in a stock hold it no matter what the conditions are. I agree with this. All right. Let's see what the DD is. Archegos, funny one. Wang pled guilty. Yeah, balling with Bill Wang. That boy is fucking crazy. Purple Line, VWAP, SMA. It's Viac. Other companies he bet big on. Wang used an instrument called total return swaps. Yep. Okay. This hypothesis is backed by no data and is really just an experiment based on the fact that meme stocks correlate. What if hedge funds are using some type of swap on them, which I absolutely would expect that to be the case. It would make sense given extremely low interest rates, not even from the interest rates, by the way. So again, to understand the context behind this, one of the really, really useful thing about swaps is you can build it to be exactly what you want. So I think that's agnostic to the low interest rate environment, because depending on how they're built, the rate environment could help or hurt. But I think that the product itself of a swap is so pertinent to this exact use case. So again, I wouldn't tie it to low interest rates, but what a swap is and what it provides. It would make even more sense given the negative beta of GameStop. Perhaps they use total return swaps or another instrument to cover to add more pressure. IDK, just a thought. It wouldn't necessarily be to add more pressure or to cover outright, but it would be to make the bet is on exactly what they want, which is underlying to go down in different conditions based on different size move, really whatever they want. So I wouldn't say it's inherently for these reasons, but it definitely is for what swaps provide. Could this be the work of an algo? No more observing similarities. Well, I think algorithms are highly trained on the retail trading behavior in GameStop. We literally saw this with, we absolutely saw this when the cat tweeted about Chewy. Chewy's price movement was insane. And we looked at that closely. And it happened at a velocity that it literally, we can not definitively, but near definitively assert that that was algorithms that were moving off of that. So completely think that algorithms are part of this. And I wouldn't bother saying if it's all the work of an algo or partially the work of an algo, though that element really we won't know. But I absolutely think that it's very, very easy to say like, yeah, algorithms in general are heavily involved in this broader process without a doubt. Completely believe that. Scott says, worked at a swap dealer firm, Zaner, and when you hear the word swaps, think bespoke, multi-leg transaction. Yeah, that's a great way. That's a great way to phrase it. And the other thing is, in terms of like the quote unquote number of legs even is really interesting because the way to think about, I would build on to what Scott said. I think the bespoke element is absolutely the most important part, but to think about what bespoke means in this context. And again, Michael Burry in The Big Short is such a great example of that. It's essentially the ability to build something that directly exposes you to the specific thing you want exposure to. A great example of this is variance swaps. So if you're a retail trader and you're trying to trade the difference between implied and realized volatility, you have to use options. And when you're trading options to capture that vol variance, you essentially have to continually delta hedge, which has a cost associated with it. There's a lot of things that make it a very impure way to express that idea. Whereas a variance swap is the complete opposite. It removes everything else. And it says this is the only thing that this is essentially going to react to in terms of the performance. So that's the cool part about swaps. And it's not relegated to price. It's not relegated to just volatility in a vacuum. It's really exactly what Scott's saying, a bespoke thing. So you can build, it really is like a choose your own adventure kind of thing. Now, again, there are bounds on it and whatnot, but definitely way more opportunities to specify your exposure, way more than on the retail side. All right. A lot of you probably extremely excited for earnings on the 9th. Not to get your hopes up. Okay. In one of my posts, I said something along the lines of retail's tapped out. Thankfully, another user made a post disagreeing with that and got tons of replies of apes saying things like, I've tripled my position. Okay. Okay. So I think this is like, I really, really like this piece a lot. I think the analysis that they did was relatively good. I think it's missing some really important elements with respect to making like the outputs a little bit more robust with what you can take away. And like the correlation analysis, for example, and then also the movement-based analysis on a green day. I was a little bummed on that because a green day is just so open-ended. Markets exhibit positive drift. You have to like break apart that movement a lot more to get to the bottom of like the actual FTD cycle. That's what makes the whole FTD cycle so challenging. to track down because there are so many variables when it comes to the movement of a stock that you have to be able to like successfully decouple quite a few components of it to actually be able to say like, yes, this is the primary driver of the price movement, which becomes really difficult to do. And this goes back to what I will always bring this conversation back to, because I love looking at this stuff, but it is so simple in the broad context. Every single big move GameStop has ever had has been preceded by massive expansions of volume. Every single one. So while we do this research and we enjoy understanding these different theories, cycle analysis, so on and so forth, always remember what I just told you. Before every single time GameStop has had a big move, every single time there is a massive run of volume before the move. It's not on the move. It gets exacerbated during the move, but it's before the move. Now, do not misconstrue that into any time GameStop has a big change in volume, it means there's a big move. That's not the case at all. This is a difference, and this is why there's a nuanced relationship between things like correlation, but then predictability. So just take that and make sure that you understand the difference there. The reason why I always express that is because it can get really overwhelming trying to track all these different timing theories and, you know, going through the DD, but the ultimate end user perspective from a trading lens is actually, it literally is that simple. That's how I trade it. The reason why I go through the DD library and all that stuff is literally just because I'm interested. It is not because I think this is going to make me trade GameStop better. I actually think the opposite almost. I think when you go too far into that, you start seeing things that may or may not be there versus just following what is there. And again, I can objectively tell you what is there is before every single move, there is a massive change in volume. This is a great example here in April. Notice how the move gets really aggressive in here, but if we zoom in on this period, you can absolutely see that volume starting to jack before the move. And again, it's all relative. But if you take a look, things quiet. And then I don't know how do I see the volume? I don't know what the volume is. I can't see it. But you can see that the volume from here to here changes massively. And then it does again here to here, and then again here to here. So it's just one example of how you absolutely can just use volume. Oh, there it is. There's our way to see it. So volume went from 2.6 mil to 8.6. That's here, 2.6 to 8.6. What I like to do is I use an average volume. I'll use like a trailing 5 days or something like that. And I use two, like a 5 day and a 20 day. But what I'm showing you is a massive change in the volume. It literally goes from 2 to 8 to 36. When you see that kind of massive changes in volume, something's going on. Now, again, does it always mean price is going to explode to the upside? Absolutely not. But again, just always remember that point when we're going through this stuff so that you don't get super overwhelmed. This happened obviously mostly because of earnings. You have to remember the context, but hopefully worthwhile. LC says back then, a fascinating part of the mystery and swap basket case was costs, the most highly correlated with GameStop yet without options. Yeah, and I think there was a pretty big exercise that Newton and I went through analyzing costs specifically relative to GameStop. And there is an uncanny relationship really with XRT. And I think we absolutely got to the bottom of that through, I think it was from Stanford. I forgot what institution talked about essentially creation redemption. And that's a big part of this whole story and the correlation between the names. Scott says you just described what a master's in economics is, how to isolate what you're trying to measure. Yeah. Yep. That's exactly it. Wow. Super cool. Very enjoyable session. It is time for me to bounce, go grab some dinner, but really great hanging out with everybody. As always, if you need anything, you can hit me up. Like I said, for the Saturday series going forward, I'm going to integrate other names for us to look at too from the meme stock basket, just because I get people that reach out and ask if we can. So the answer is a absolute yes. Just let me know. You can hit me up in the Discord. It's completely free to join. Or it's an easy way. Throw it as a comment on a video if there's a specific ticker that you want to look at. As always, if you have any questions, let me know. Be an outlier. I'll see you guys later.